sir.
Yeah. Okay.
Very good morning, one and all, for the webinar series, National Commercial Law Webinar Series organized by KLE Law College from 1st September to 5th September 2020. It's my honor and privilege to extend a very warm and hearty welcome and introduce respected Ramasubramaniam Gandhi to this webinar series. He born in 1956. He has been educated in India and abroad. He has a master's degree in economics from the Annamalai University in Tamil Nadu, India. He also has postgraduate level certificates in management information system from the American University, Washington, DC, USA, and in capital market from the City University of New York. His technical education includes a certificate course in system programming from IBM Education, Sydney, Australia. He also has a certificate in Gandhian Thoughts from the Madurai University, Tamil Nadu, India. He has been associated with the various committees, working groups, and task forces, both domestic and international level. He was one of the initial member of the Monetary Policy Committee. He was a member of the BASE Committee on Banking Supervision and the Committee on Global Financial Systems BASE. He was a Deputy Governor of the RBI for the 3 years from 2014 to 2017. He had been a seasoned and accomplished central banker for 37 years. He had a 3-year secondment to the Securities and Exchange Board of India, the capital market regulator. He also had held the charge of Director of the Institute for Development and Research in Banking Technology, Hyderabad. Presently, he is a financial sector policy expert and advisor. Currently, he advises banks, financial companies, fintech entities, payment system entities, investors and funds on subjects ranging from financial regulations and Indian economy. He is a prolific speaker and covers including these areas in a wide range of subjects. A very hearty welcome to this session, sir.
Good afternoon.
It's my privilege to extend a very hearty welcome to our navigator, leader, our beloved principal, Dr. J. M. Mallikarjunayya, sir. So please welcome to the session, sir.
Thank you. Sir, welcome to you, sir.
Welcome. Thank you. Thank you.
I take this opportunity to welcome Academic Coordinator, Dr. Anita MJ, IKSC Coordinator, Dr. Manoj Kumar V. Hiremet, and all the faculty members to this session. Welcome you all. Last but not the least, my special welcome to young students and other faculty members from the different colleges whose participation would undoubtedly make today's program more lively, vibrant, and enriching. Once again, I welcome all of you for this today's session, and over to you, sir.
Thank you. Good afternoon, everybody. Once again, a very warm good afternoon. I'm very happy to be interacting with students. It has always been a pleasure to be interacting with youngsters throughout my career also, and post my career in the Reserve Bank also. I've been very happy to be interacting and sharing out of years of experience, whatever little knowledge that we have gained to pass on to the next generation. So that is all, and thanks for that opportunity given by KLE Society, Law College. And being law students, that is another experience to me, because as a regulator, our primary duty is to implement the provisions of various statutes which are entrusted in the care of the Reserve Bank of India. So that way, even though I'm not a lawyer, but certainly I can appreciate the nuances of the law and the way we implement it, and number one. Secondly, this week you are all conducting a series of programs where I saw in the among the program that every other session is basically relating to law, and this is a one session which is not directly related to legal issues. It will be, I am sure that it will be a kind of good diversion for you away from the legal aspects of the discussions. So I am going to be talking more about the Reserve Bank of India, its primary role in the financial sector, so that you will get an overall sense of what is this institution, what it has been doing all these years, and what are its various objectives and the way it has performed all these years. So that's what I intend to do. And towards the end, of course, through the question and answer sessions, whatever additional clarification that we will need, I'll be happy to do that. So let me share a presentation with all of you. Just give me a second. I hope you are able to see.
Sir, kindly share the screen, sir.
1 minute.
There is an option, sir. Share
Yeah.
screen.
Yes. You are able to see now?
No, sir.
Not yet? Just 1 second. Now we are able to do?
Yes, sir. Yes.
Yeah. Okay. So as I said, that I am going to be talking about the primary role of the Reserve Bank of India in the financial sector. So by the functions of a central bank, there are two types of functions. One is a traditional set of functions, which many of the central banks do all over the world. And there are certain non-traditional functions which got added in the recent times. The central bank as a concept had started way back in 17th century. And the traditional functions were typically, it is the central banks which issue the currency notes, and it is a banker to the government, bankers to bankers bank, lender of last resort, and it is a manager of credit and exchange rate system and reserve management and all. Monetary policy is the key function of a central bank, and regulating banking and financial system got added as the banking system expanded and other financial sector expanded. And among the non-traditional functions, basically it relates to the central banks in the developing countries where development and growth has been assigned as additional task for the central banks to take care of. So that is where central banks have been assigned to undertake policy actions for promoting production, employment, and real income, and also through promotional responsibility for starting new financial institutions and attending and focusing the credit flow into particular segments of the economy or say segments of the population. So that is a non-traditional function. But it is not that all banks, all central banks carry out all these functions. There are notable exceptions. As you can see in the Federal Reserve of USA, they are not a reserve manager. Forex reserves are not managed by the Federal Reserve Bank. It is rather managed by US, it is managed by the government itself. Bank of England till 1990s, it was not responsible for the monetary policy. That's a very big exception in those days. And currently, the European Central Bank, it is not a bank regulator and it is not a reserve manager also. Bank of Japan is not a reserve manager. Hong Kong Monetary Authority, it is not even issuing the currency. Currency in Hong Kong is being issued by the commercial banks. Like that, different exceptions are there. This is more for your information. And then RBI, of course, RBI has the primary statute under which it has been created, the Reserve Bank of India Act 1934. And added to that, there are many other statutes which have been assigned to the Reserve Bank to take care of. One is the Banking Regulation Act of 1949, then Deposit Insurance and Credit Guarantee Corporation Act of 1961, Foreign Exchange, earlier it was FERA, now it is FEMA, Foreign Exchange Management Act of 1999, then Credit Information Companies Act 2005, Government Securities Act of 2006, and Payment and Settlement System Act of 2007. All these statutes have put greater responsibility on the shoulders of the Reserve Bank of India to take to implement the provisions of these acts. very important to talk about when you want to understand the Reserve Bank of India. The preamble of the Reserve Bank of India Act 1934, that gives a bird's eye view of all the functions that have been assigned to the Reserve Bank of India. I am just picked up from there. Exactly, I am quoting here. As it is expedient to constitute a Reserve Bank of India to regulate the issue of banknotes, keeping of reserves with a view to securing monetary stability in India, and generally to operate the currency and credit system of the country to its advantage. This was the preamble until 2016. In 2016, through an amendment, government has added additional responsibility, explicit responsibility to the Reserve Bank of India to say that to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of the growth. So here, whatever I have indicated in the block letters, that is the primary duty or primary responsibility or functions of the Reserve Bank of India. Issuing banknotes, keeping reserves, securing monetary stability, and operate the currency and credit system of the country to its advantage. So monetary policy is a part of the monetary stability. So now let me give you a quick flavor of all these major functions, how Reserve Bank has been performing in all these years and in comparison with some international practices also. So first is the issue of banknotes, because that the very distinction between the central bank and the rest of the banking system in anywhere in the world, it is the issue of the banknotes. The currency notes are being issued by the central banks. Here, the objective of the Reserve Bank is to take care of that the economy has adequate supply of clean and genuine banknotes. Supply today, once upon, for 20, 30 years before, the major part of our currency notes, components, paper, even printing used to be got imported. But now from 1990 onwards, we have expanded our installed capacity of producing and printing the currency notes within the country itself. As of date, we have 4 facilities in the country which take care of the complete requirement. 100% of our requirements are getting produced within the country itself. Then the clean notes, that the Reserve Bank periodically, continuously removes the old soil notes from the system and gives new currency notes to the public. So that way it maintains the cleanliness of the notes. And the genuineness, there is of course, it is a very important function to keep the confidence of the public in the currency notes that are being issued by the Reserve Bank of India. It has to give a high assurance that the notes are genuine and they are not counterfeit. Yes, there are certain nefarious people who try to make attempt to counterfeit the notes, but most of the time the counterfeits can be easily be noticed by even ordinary people, and they can get caught, and unless somebody very blindly accept this kind of notes. But in recent times, because of the technology which is continuously getting sophisticated, and at very cheap cost, people down the line also will have access to high-end technology. Sometimes this high-end photocopier, using that, the people can easily, they do make an attempt to counterfeit the currency notes. But there again, the quality of the paper, the moment you feel it, you will know the difference between good quality genuine notes and bad forged notes. So that in any case, it is a continuous effort by the enforcement authorities to go behind these counterfeiters and booking them under the various provisions of the law and bringing them to punishment. But this phenomenon is there, but it is well under control in recent times. So if you look at the figures for the past 20 years or so, I have put the figures here, how the currency in circulation has been increasing. Earlier, before the last century, before 20th century, currency was the only currency. Money means currency. That was the only medium of exchange. But as the banking system got expanded, the concept of money has changed. It is cash or currency is only one part of the money. The other part of the money is that the people who have accounts with the banks in terms of current account or savings bank account, which are freely used for transferring money between one person and another person, that is also money. So that is a currency plus the deposits in the banking system together. It is called, broadly, it is called broad money. That broad money is the real indicator of the medium of exchange rather than just currency. That's why I have given both the figures here. You will find here currency is just hardly 1/6 of the total money in circulation. That is why the central banks in recent times and from last century onwards, they do not operate much on the currency aspect of it. Whatever the economy requires, whatever the people require, in whichever denomination the people require currency, it is getting printed and given. Because after all, out of the total money in circulation, currency is hardly 10 to 15%. So maybe it can always take care of the total money supply, which means the broad money. That is what is actually important for managing the monetary policy or controlling inflation, not just the currency. So the central banks have moved away from giving importance to currency to the total money supply. Then when we compare, this is a recent figure given by IMF for the year 2019, where the broad money growth rate, how it has been in different parts of the country. There you will find that India is in the middle segment, around 11% or 12%. So neither we are a very high growth money expanding economy or a very low economy. We are in the middle path. Now, the second function is about keeping the country's foreign exchange reserves. Foreign exchange reserves are very important, especially for countries like us, the developing countries, because the international community of investors, whether they are direct investment or they participate in through the portfolio investment and others, they all gain confidence if the country has enough foreign exchange reserves to take care of fluctuations in the foreign exchange. So that is why managing the foreign exchange reserve has been given top priority by the central banks. If you would recall that in 1991, the country faced a very severe foreign exchange problem when our foreign exchange reserves went below about $1 billion. That is hardly $500 million we had at that time. From that time onwards, due to various reforms, financial sector reforms that we brought on to the country and in the real sector, continuously our reserves have been increasing, and that's what you see in this graph, that as of now, today we have something like $500 billion foreign exchange reserve. That is our country. If you look at the other countries, whereby the top 10 countries in the world I have put in this slide, there you will find that the biggest foreign exchange reserve is in China. And the next, Japan, Switzerland, Russia, Saudi Arabia, Taiwan, Hong Kong, India. So that way, actually Saudi Arabia, Taiwan, Hong Kong, India, all of them are almost similar, something like $450 to $500 billion. So China has really been a very exceptional country, which accumulated foreign exchange reserves in a very big way. Their total reserves are something like $3.4 trillion. If you add Hong Kong, which is also nothing but China for all practical purposes, then another $500 billion when you add. So the total China foreign exchange reserves works out to be $4.2 trillion. And that is the financial power, muscle power it has got against the US, because most of the foreign exchange reserves, major part of the foreign exchange, almost all countries keep in terms of dollars only, dollar assets. So a very large portion of the $4.2 trillion of wealth China has in US. That is why they're able to gain that kind of importance in the world today. But how did they build up these reserves? This is there are two ways the foreign exchange reserves can be built up. One is you go on exporting more and more than the importing. That means you are a net positive export country. In that case, to that extent of positive gap, your reserves will be going on increasing. That is one method through which the foreign exchange reserves can be increased. The other method through which foreign exchange reserve can be increased is based on the capital flows, that is borrowing. If you go on borrowing more and more from foreign countries, or the foreign investors keep their investment in the stock markets or in the real sector of your economy, that time also the surplus dollars that can go into increasing your reserves. So that is current account deficit countries. These kind of countries are current account deficit countries. That way, through the capital flows surplus only, you build your reserves. India is in that segment. It is of that variety. That's why there's a big difference between China and India in terms of foreign exchange reserves. China built its foreign exchange reserves more by exporting more. It is a current account surplus country. Current account surplus means that they are exporting more than they are importing. Whereas India is current account deficit country. That means that we are importing more than we are exporting. And for that purpose, to meet the gap, we do get support in terms of foreign exchange flows, in terms of capital. That is why through which we built our this important information you should keep in mind. Now, the third function relates to monetary securing monetary stability of the country. That is basically controlling inflation. So there, if you look at I will in the later slides, I will explain more about exactly how do we set the interest rate and manage the inflation. That will come later. Right now, I have given only the position over the period of some 50 years, 60 years plus, how Indian inflation has been behaving. You will find here that inflation in India had been ranging between 5% to 15%. Most of the time, it is around 10%. So that is why that is a high inflation economy. Yes, there are examples of some South American countries and African countries where inflation had started up hyperinflation, something like the 400%, 500% inflation. Also, from compared to that, we are far removed. But still, any inflation around 10% or in the double digit, it is considered a high inflation. That is why we remind the high inflation economy throughout this post-independence, the figures that I have put here, we have it. But in recent times, obviously, because of the initiation of inflation targeting and monetary policy committee, which has come into the picture from 2016 onwards, there is a tight control of inflation and in modern times. Next, about the other, if you recall in the preamble, it is said that the Reserve Bank has been established to operate its currency to its advantage. So how the INR, that is Indian rupee, versus US dollar rate behaved throughout this some 30 years. That's what I have shown here. Here you will find that Indian rupee has been continuously depreciating, which used to be around 16 rupees in just before the 1991 crisis per dollar. Today, it is something like 73 rupees, or even, it went up to 76 rupees also in just a few weeks before. So continuously, Indian rupee has been valued, it has been losing its value in terms of dollar. Whether it is good or bad, that I will, again, in the later slides, I will start explaining that. But right now, take note that Indian rupee has been continuously depreciating. Next, how the banking system, the financial stability, which is another, the credit system of the economy, that also to be operated by the Reserve Bank to the country's advantage. That's what I have shown here in the last 30 years, how the bank deposits and bank credit has been growing. There has been continuous growth of bank deposits and credit growth throughout this period. And whether this growth is sufficient or not, so there is a different view. That is why if we compare to the other countries, which I have done here, there is one metric through which people try to gauge the contribution of the banking system to the country's economy. That is, they compare the total credit to the private sector and the GDP ratio. This ratio in almost all the advanced nations, there this ratio has been more than 150%. That is more than 1.5 times to 2 times. Whereas the BRICS economy, there's the developing economies, which I have shown here in the dotted lines, you'll find that they're all in the region between 50 to 75% of the GDP only. So that is an indicator that our bank system has to still to grow. One exception among the BRICS economy is China. That you can see in the top one. That is the credit to GDP ratio is almost 200. That is 2 times. So the credit is 2 times of GDP, whereas in our country, our credit is hardly half of GDP. So that way, we have a lot of things to do before reaching a developed economy. Our banking system should be able to create more credit and offer more credit to the system as a whole. See, these are the basic 5 functions which I have given in comparison with other countries. Now let me explain more about the interest rate setting. That is about the inflation control and foreign exchange control, and thereafter something about the bank's control. These are the 3 I want to pay little more attention to these 3 segments. So one more is about the payment system. So the payment system is another area Reserve Bank has been doing a lot to improve, to bring in more and more of digital payments. So you'll find that the importance of the paper-based payments, that is checks and all, it had been continuously coming down. You can see in the left picture, left chart, the blue portion, which is in 2011-12, the paper instruments accounted for almost like 18%. Continuously, it has been coming down, and in the last year, it has come down to hardly 4 or 5% in terms of volume. In terms of value also, you will find that the portion, the paper instruments, that has been continuously coming down. It is more, the rest of the payments are all through digital systems. That is very important things to note. Now, let me talk more about the monetary policy, the interest rates, and the exchange rate. In every economy, certain macroeconomic factors have to be in balance, or rather not necessarily in balance. The economists discuss about 3 types of balances. One is the investment and savings balance. So the community as a whole, whatever they save, it must be invested. In that case, there is called the investment saving balance is achieved. The second is current account balance. That is imports and exports. If they are equal in an economy, then it is supposed to be set as they having current account balance. Then GF, that is government deficit, government finance balance. That their government taxation and other revenues equal government's expenditure. In that case, government finance is in balance. These 3 balances, whenever there is imbalance in any one of these 3 or all in any combination of these 3, it can create disturbances in the economy. So these imbalances create the imbalance between investment and saving, imbalances between current account, that is imports and exports, and imbalances between government revenue and government expenditure. If it is there, it can create business cycles. It creates business cycles. Business cycle in the sense that suddenly there is a lot of exuberance in the economy. People are, the businesses are investing more and more, expanding their capacity, and everything is looking rosy. Markets are booming. Stock market is booming. Then suddenly something happens and the stock markets fall. There is a dejection among the entrepreneurs, and they start shrinking the production, and they start employment, they start reducing, and it leads to unemployment and reduction in income, and the consumption gets reduced. Then the economy has gone to the bottom of the trough. Then again, positive feelings come up, then the business cycle starts again. So this business cycle movement, that is primarily created because of the imbalances in any one of these macroeconomic variables. There are positive, but there are 2 concepts. The gap could be negative, the imbalance could be negative, or imbalance could be positive, in the sense that investment can be more than saving, or savings can be more than investment. The imports can be more than exports, or exports can be more than imports, like that. So that way, there are the imbalances could be having a positive gap or negative gap. Now, there is a lot of discussion about whether any economy should be in balance all the time. Is balance is a desirable objective, or gaps is a desirable objective? Then among the gaps also, whether positive gap is good or negative gap is good. Here my take is that nothing is rule bound, or rather there is no clear formula which country at what point in time should have a balance or not have a balance, or should have a positive balance, gap or negative gap. It all depends about the context. The context is very, very important. The time at which the economy is facing itself is very important. For example, when our current account, as of today, we have a current account deficit. That means that our imports are more than our exports. That is it desirable? It may not. It is not desirable for us as a growing economy. As a growing economy, we would want more export to take place, because more exports means we are producing more. We are producing more means that we are creating more income and employment, and more income, then the people's standard of living goes up, growth because of the growth. So that way we would desire to have current account surplus. But like, for example, today China has current account surplus. Is it good for them to have current account surplus? Because it is in current account surplus for the past 20, 30 years. So there has been that continuously, if you are having current account surplus, that means that you are producing more for some other person, some other country's citizen, not for your own citizens. So your own citizens are not getting the advantage of the goods that you are producing. So the standard of living has not gone up. So that is a counter theory. So nothing, as I said, that nothing in this balance is permanently correct or permanently wrong. So it need to be in the given context, something may be good for a country, and for the same country in another context of time, the opposite may be true. That you please keep in mind. Now, why we talk about these imbalances? As I said that whenever there is an imbalance in any one of these macroeconomic variables, it leads to trade cycles and business cycles, and because of that, there could be growth getting affected, speeded up, or there could be recession, or inflation could be rearing its head up, or there could be deflation. Because of such impact on growth and inflation, these imbalances are critical to manage. So in almost all the countries, the responsibility for managing the growth is in the hands of the government, and the responsibility for managing the inflation is in the hands of the central banks of the country. The irony is that if you want to manage growth, then you would be wanting the inflation control to be loosened up. Or if you want to be controlling inflation, then you would advise that don't bother about growth. So this way, there is an inherent conflict between the objective duty assigned to the central bank and the objective duty assigned to the government. So that's why you find that off and on, there could be some kind of discussion in the media and others saying that the government and the central banks are at loggerheads because of their specific, the objectives do differ. Now look at the inflation targets, which different countries have been assigned either statutorily or they have a de facto, they are adopted that kind of objective. As I said that from 2016 onwards, India has adopted for inflation targeting monetary policy. Before that, in de facto we are doing. Now that after that, it has become the law. Like that, in many countries, there is a law requiring the central bank to keep the inflation between the range which I have indicated here. You'll find here that the developed nations, their inflation targets have been around 2%, 0 to 2%. And the developing countries like us, the typical inflation targets range between 4 and 6%. So that's why we call ourselves a high inflation economy even today compared to the best developed advanced economies, because advanced economy would mean that your inflation is near about 0. But near about 0, does it mean that negative inflation is good for you? Definitely no. Nobody would want the inflation to be negative, going below zero, because inflation going below zero would mean that your country is in recession. Nobody likes recession. Inflation, high inflation, nobody likes, but reasonable, moderate inflation is always liked for, because that is what will lead to positive sentiments. Looking forward, entrepreneurs have to have a rosy picture about the future, so that they will start installing machinery, they will start expanding their factories, they will put in new business, and they will employ more people, and thereby creating more income for the public. So that is why inflation is a desirable one, but it has to be in the low digits. Anything between 0 and 4 or 5% is the best inflation any country can hope for. It should not be more than 5, or it should not be less than 0 or kind of. So that is what is a challenge which the central banks keep in mind, because in any democratic society, the challenge the central bank has is this one only, because private individuals, when they expect inflation to rise, they will take protective action, and because of that, the central bank will be in a dilemma whether we should allow the inflation to take place. In that case, because when the expansion takes place, you have to pump in more money. When more money is there, it will lead to inflation. Is it good? And that way, we have avoided a recession, or because of that, or if you do not accommodate inflation expectation and avoid inflation, if you start stopping money supply growth, then recession could keep coming in. This is a big dilemma which central banks face, and they have to take their actions in a very, very fine way. Now, interest rate setting, how it is being done. As a consequence of the primary duty of monetary policy, that you have to control inflation, the central banks control inflation through setting the interest rate. So in any economy, 3 important types of interest rate is very important. One is long-term rate, other is short-term, and other is overnight. See, the long-term interest rate is typically, the yardstick is the government when it borrows long-term, typically 10-year bond when it issues, at what rate it is able to raise money. So that is long-term rate. The short-term rate is the policy rate announced by the Reserve Bank of India, the repo rate, at which it lends money to the banks. That's a policy rate. And banks among themselves borrow daily money. They will borrow today and repay tomorrow. So that is another important interest rate, that is the interbank rate. These 3 are very important. Of these 3, the long-term interest rate, they are, as I said, that is the one which determines at what cost the government is borrowing, because typically government borrows in a very large amount. In the current year, government has budgeted to borrow something like 12 lakh crores of rupees. That's a very large money. So today, post reforms of 1990s, the interest rate at which the government borrows, it is set by the market. Set by the market means that based on the demand of money by the government, the lenders, there's a banks and the investors in the government bonds, they determine at what rate they are ready to lend money to the government. Before this 1990 reforms, the Reserve Bank used to fix that rate, but post reforms, it has been left to the market. But central banks keeps a hawk's eye on the rate at which the government is able to borrow. That means the government is able to raise money from the market. If the market participants, they determine the rate based on the government's overall budget proposition, budget deficit, the size of the budget deficit, the government's spending behavior, whether it is spending for capital investment or it is for revenue expenditure, and how the economy is going to grow, and other inflation, how the people are expecting inflation. All these considerations they keep in their mind while demanding a particular interest rate in the market. Now, the short-term interest rate, there's a policy rate announced by the Reserve Bank of India, that a Monetary Policy Committee. The Monetary Policy Committee keeps several factors in mind before determining whether the rate should be kept neutral or should be increased or should be reduced. So the bottom I have given very many indicators because it keeps external factors also in mind and domestic factors also in mind. External factors primarily relates to how the other economies, more specifically the advanced economies, are growing, their inflation prospects, because our exports and imports depend upon the other countries' growth prospects. So that is one. Then how the oil price is moving, that is another very critical factor Monetary Policy Committee keeps in mind while determining the interest rate. Then the financial markets and currencies, all those things it keeps in mind. And in domestic factors, among domestic factors, it looks at the growth of agriculture, industries, service sector, and the inflation, both of wholesale price and consumer price inflation and its prospects, monsoon prospects, like that. It considers very many factors, and based on that, it makes a judgment what's the likely inflation and what's the likely growth. Based on that, it decides whether the interest rate should be increased, decreased, or kept at neutral. So that's the way it is done. Then overnight interest rate, that is purely demand and supply between the in the market between one bank and another bank. Based on that, those interest rates are being set right. Now, if you look at the post monetary policy committee, which came in, which got constituted in October 2016 onwards, every 2 months they have been announcing their monetary policy actions and measures. This is what I have listed here. So continuously you find that every 2 months they have been taking decision whether to reduce rate or increase rate or keep it neutral, or how their stance in the sense that they will be wanting to accommodate the request of the banks for additional money or not. Tighten means that the Reserve Bank will be controlling, it will be sucking out the liquidity. If it says accommodative, that means that it will be ready to pump in more liquidity into the market. Liquidity means money, more money into the market. Neutral means it will be keeping the balance. So that's the way throughout this 2 3 years period, continuously MPC has been operating. How far its inflation targeting has been achieved, that is in this graph I have put there. The green line indicates what they projected, MPC projected. Red line indicates what was the actual inflation during this particular period. Here you will find that almost, except the last 2 instances, the monetary policy projection, that is Reserve Bank's projected inflation, has been more than the actual. Actual has been less than projected. That means that more or less, and many occasions, it was almost on dot, kind of, except the last 2. So this way, that means that MPC was able to read the prospective inflation correctly so far. Now, coming to exchange rate, because there is another mistake. Many people want to know how the Reserve Bank sets the exchange rate. Reserve Bank used to fix the exchange rate, etc. means the rate between Indian rupee and US dollar and other currencies. Before 1991 reforms, Reserve Bank used to fix the rate. But post 1991, based on the reforms, it is now the market which determines what should be the exchange rate. That is based on the supply and demand. So, sorry. Different factors influence the market consideration about whether today the rate will go up or will come down. Inflation rates in the respective countries, interest rate in the respective countries, current account balance, whether this country vis-a-vis other country, how the current account is behaving, that is the imports and exports are behaving, then capital flows, the country's own foreign exchange reserve position, like that. Any number of factors which the market players keep in their mind before demanding the dollar at a higher price or lower price than yesterday. So based on any movements in any one of these factors, market moves. So there are 2 things when we talk about foreign exchange rates. 2 things we have to keep in mind. One is the day-to-day movements, and the other is non-day-to-day movement. This is a secular trend, a longer-term trend. So in the day-to-day movement, it is typically by the Reserve Bank's exchange rate policy relates to addressing the volatility. because the Reserve Bank has decided it won't fix the rate, market will determine the rate. When the market is determining, it keeps a close watch on the market and see whether the exchange rate movements between yesterday and today or within the day, between 1 hour and another hour, that the difference, the changes are not volatile. Means that too much of increase or too much of decrease in the rates is bad. You have smooth movement, whether it is appreciating or depreciating, it is material, it doesn't matter. But so long as it is happening in a smooth way, in an undisturbed way, without causing panic in the market, then it is okay. So when there is sudden spurt in the market, because large, clumpy dollars demand is coming up or dollar supply is coming up, and because of that the rate shoots up like anything, and that is the time Reserve Bank will intervene to either to supply additional demand, additional dollars if demand is more, or if the surplus is there, it will take it, it will buy it. So these day-to-day movements by Reserve Bank keeps a close eye, and to remove the volatility, it intervenes in the market to buy or sell the dollars. It is Reserve Bank does not have a view at all whether rupees should be appreciating or rupees should be depreciating. It operates on both the sides of the market just to smoothen the volatility in the market. But non-day-to-day movement in the long term, over a period of years, that time what is happening is that country would like to keep its competitiveness, in the sense that like our economy, there is a developing economy, and that too in a current account deficit country. That means that we need to be our imports are more than our exports. That means that we need to be continuously supporting our exports more than our imports. If that is a policy objective, then normally you would want the rupee to be depreciating. Because if the rupee depreciates, then the exporters get more Indian rupee for the same set of goods that they have sold abroad. So that is a desirable objective in a developing economy. But for that reason, will you deliberately depreciate the Indian rupee? No. You will only find that in a smooth way over the period of 6 months to 1 year, they allow the depreciation to take place. So that's the way Reserve Bank used to manage the exchange rate functions. Now, banking. This is the last segment before I open up for discussion. So in the banking regulation, the recent over the period, the policy and rationale has been changing. So the current policy towards regulating and supervising the banks are like this. So it is increasingly aligned to global standards. There is a global consensus about how the banks and financial institutions should be regulated and supervised. There is a committee in Basel, Switzerland, where all the central banks are members. There they periodically meet and decide and develop the strategy, a common strategy for all the countries. So that's where Basel norms you would have heard about, that comes out of that committee's recommendations. So, and in India, because we have varieties of banks, we have government-owned banks, we have private-owned banks, foreign-owned banks, cooperatively owned banks. So different type of owners are there. Earlier, it used to be based on the ownership, the regulation used to be different. If you are a public sector bank, there was they were regulated, supervised distinctly different from the private sector bank like that. But increasingly, Reserve Bank has veered more towards a common approach towards or neutral approach towards ownership. Irrespective of the ownership, you will be regulated in the same way. So that's a current approach. And earlier, Reserve Bank used to give a lot of forbearance. Forbearance means exception to the regulation. It will announce certain regulation, and based on the ownership of the institution or for other reasons, it used to give exceptions to particular institution. That has been found to be not good. So nowadays, the Reserve Bank is not in favor of according forbearance, and it is emphasizing more and more on enforcement. Then it has also moved more towards risk-based supervision and principle-based supervision rather than the tick box exercise. Because earlier it used to be, it used to list out several factors. It will go on seeing whether yes or no kind of So based on that, it used to conclude whether a bank is okay or not. But now it is more principle-based supervision. So like that, the earlier the approach used to be that any bank which is having trouble, extreme trouble, it used to be, the bank used to manage somehow to get that either merged with some other bank or nationalize it. So that's a kind of approach it has, so that nobody is affected. But now the modern movement is not like that, because nationalization would mean that indirectly it is the government, exchequer, and the public which bear the losses. So that now the approach is, no, that is not good. It should be the owners of the shareholders of the bank who should be meeting the cost of failures, not the exchequer. So that is a current approach. Then this I will skip for a time. It is not very important. So if you look at the performance in recent times about the banks, how our banks, SCB means that scheduled commercial banks, their business indicators, you will find that balance sheet has been continuously growing. Deposits and advances have also been growing. That is in terms of business. In terms of profitability, in the other segment, you find that they continuously, the return on equity has been coming down all these years. Return on assets have been also been coming down, and net profit in the recent 2-3 years, it has been negative because of the non-performing assets, the problem that the banks have been having post 2015 onwards. Then the capital ratios, the capital adequacy ratios, that is in the bottom table. There you find that continuously there is initially in the 2012 to 2016, the capital adequacy ratio has been that green line. You will find that initially it was coming down, but afterwards 2014-15 onwards, it has been continuously going up, and it has reached a level of almost like 14.5% as of now. And the NPA had been increasing from 2012-13 to 2017-18. Afterwards, it has started falling down, and the NPA, whether it is a gross or net NPA. And the provisional coverage ratio, there's a bars, the black bars, there you will find that again from 2014-15 onwards, it has started going up, and it is now 62. That's good, because ideally provisional coverage ratio should be 100. Slowly the banks are moving towards step by step. So that means that as of now, the capital adequacy of the banking system as a whole, individual banks, that could be different, but the system as a whole, it is robust. So it continuously behaving good in recent times. So this is what I wanted to discuss about now. Let me now open up for discussions and any queries that you will want. Thank you.
Thank you so much, sir. Now we have the question and answer session. Sir, am I audible?
Yeah, you're audible. Yes.
Sir,
you can speak, you can ask.
Sir, we have few questions.
Yeah.
One question is how this repo and reverse repo system helps to maintain the monetary stability in this COVID-19 period, sir?
Okay. Reverse repo system, that is based on the liquidity operations of the Reserve Bank of India. When the financial system continuously, it requires the country economy continuously requires a lot of money to be flowing. So if additional money is needed, Reserve Bank should be willing to give, or if there is surplus money, then Reserve Bank should be absorbing it. That's a standard requirement in any economy. At what rate the central bank is ready to take the additional money from the that is it is absorbing the liquidity, or it is pumping in liquidity, that is based on the rate. That is what is the repo rate, reverse repo rate. Repo rate is the rate at which Reserve Bank lends or gives additional liquidity to the banks, and the reverse repo is the rate at which it takes money, that is, it absorbs surplus liquidity from the economy. How does it do? But it all depends upon the estimate the Reserve Bank makes on a daily basis, whether today the banks will be needing money or banks will be requiring money, rather surplus in economy. So that is one factor. it makes an estimate. Second, its own stance. In the Monetary Policy Committee, I have shown that it will have either a accommodative stance or a neutral stance or a tightening stance. In a tightening stance, that would mean that the Reserve Bank will be very hesitant to give additional money. That's the indication of tightening. When the Reserve Bank is an accommodative stance, that means that Reserve Bank will be ready to give more money when the banks will be asking for it. So that is neutral means depending upon the particular. It is immaterial whether you are wanting more or you are not wanting more. So based on the stance, based on its own forecast and the rate at which the MPC has announced, these are the combination at which reverse repo operations are taking place. Number one. Number two, on any given day, you will find that it is not that all banks will be wanting money or all banks will be depositing back money with the Reserve Bank of India. There will be differences between, say, some banks. That's why you will find that many days a few banks have borrowed from the Reserve Bank of India, but some other banks have deposited money back with the Reserve Bank of India. Both will be there. Depending upon each bank's own considerations, they will come to the conclusion whether I am surplus, so the surplus money I will park with Reserve Bank of India, or I am short, so I will go to Reserve Bank of India and borrow money. That's the way it is operated. In COVID times, the question was relating to COVID times specifically, because COVID times, the Reserve Bank has already announced very clearly that it is going to have a very accommodative stance. It created, actually from March onwards, 8 lakh crores of rupees of additional liquidity it has created. Various types of liquidity, long-term operations, short-term operations, 1 month, 3 months, 3 years, like that, various windows it opened for the banks to take money. So during this period, Reserve Bank has been very, very highly accommodative.
Thank you so much, sir. One more question, sir. Can you throw some light on the Supreme Court verdict on the moratorium period, sir?
Yeah, in the last slide, I had actually put that set of, I thought that as law students, you all will be interested in knowing that. Yes, moratorium, there are two things. Of course, it is sub judice. That is number one, that given within that constraint of that law, let me give my views here in the sense that banks are commercial institutions. The money that the banks lend, it is the money given to it by the depositors, that is the general public. So when if we take a decision that the borrowers need not pay interest to the banks, in that case, how the banks will be able to pay interest to the depositors, that is a very important consideration which has to be kept in mind. That's what Reserve Bank has presented to the court, saying that the financial stability has to be kept in mind. There is a limit up to which we can be accommodative to the borrowers. It cannot be an open-ended type. In that sense, or one-sided. Then we have to keep the overall balance of the overall profitability and capital of the banks in view before deciding whether a moratorium, interest on moratorium should be applied or not. Moratorium per se, that's a different question. Moratorium means that you are giving more time for the borrowers to lend back. That Reserve Bank, until now, 6 months period it has already given. Now what it has said, instead of across the board extension, it will be based on case by case. The banks will determine whether they want to give additional time or not. That's what it is. Next question.
Good afternoon, sir. Sir, yeah. We are getting a flood of questions and it's very hard to restrict the questions, but this is a very interesting question. Indian banks have gone through a wave of NPA crisis, and we are very privileged to have you because you were in the thick of things when banks were sorting out NPA crisis under the leadership of Raghuram Rajanji and all of you deputy governors. Currently, because of the moratorium and COVID situation, there would be another wave of these NPA coming, especially from the retail sector. How do you think law or regulation can help in this part to solve this situation?
Right. So again, because of managing policy in times like this, you have to factor in all possible impact. You can't see only from the perspective of the borrower. You can't see only from the perspective of the bank's own balance sheet. You can't see only from the perspective of the investors, that is about depositors and shareholders. It has to be a judgment based on combining all these factors. That is number one. Number two, when you want to manage, obviously, because there has been loss of employment, loss of income, several segments of the economy were locked down. So obviously, whichever businesses belong to those affected sectors are the people who happen to be dependent upon those sectors for their employment. All of them have found themselves to be today less of cash. That would mean that they are unable to repay their loans, whether it is a retail loan or even a business loan, they are unable to repay. So this particular group could become a non-performing assets, because obviously it is not their own making. It is something totally beyond their own capacity to meet that. So under such circumstances, what we should be doing? That's where now there is the standard principle will be that by restructuring these loans, by giving additional time, by changing the terms of the the lending, reducing interest rate, increasing the period of repayment, and announcing that for a particular period you need not repay until your business gets revived. So those kind of combination of the thing, that's what we call the resolution plan for each individual borrowers. That is one way of managing the thing. Until that time, the banks will have to cope with lesser flow of income from these borrowers. If the banks will be able to take care of that because they have been sufficiently capitalized, their other profits from other performing loans is sufficient enough to meet this loss, then it is okay. That is a judgment the Reserve Bank will make in terms of whether it is possible for the banks to stomach these kind of temporary losses for the next 1 year, 2 year period. So that it will factor in. The second method is it will tell, okay, because these loans are likely to be increasing, NPA is likely to be increasing, that would mean that you will have losses. That would mean that you should shore up your capital. You should raise more capital. You should have sufficient capital so that still after meeting these losses also, you are still having sufficient capital to pull on. So that is a second requirement Reserve Bank will be prescribing. As we understand that the bank has already advised many banks, you go and raise more capital from your shareholders or otherwise your investors, so that the oncoming NPA increase you'll be able to manage. So that's the way where Reserve Bank will be taking actions.
Yes. Sir, one more very, very sharp question. And I leave it at your option to answer this or not, because you have been in multiple places as director. The question to you is that in India, we have seen of lately, lot of financial institutions fail. Example, Island FS, Yes Bank, or PMC Bank. Whether the problem is with respect to under-regulation or whether the problem is with respect to implementation, and is this the fault of RBI?
Okay. See, regulation it comes much later. Day-to-day operations of a financial institution, whether it is a bank or an NBFC or another, it is the responsibility of the management. Then the internal control system, there's an audit, then there is an audit. And thereafter, the external regulator comes and supervises them periodically, either by way of off-site supervision in terms of seeking data and information, or on the spot going and checking the books of the respective institution. So there are limits about the capacity of the regulation to be fully under control of, keeping a bank or an NBFC under control. So primary responsibility for running an institution properly rests within the institution itself. That's the first rule. So it is not that just because a bank is failing, it automatically means that there is a failure of regulation. It needs to be seen what were the contributing factors to these specific failing institution, whether the contribution has come from the governance failure or it has been because the regulators have been lax, and in the past by several once things were happening bad, and as the regulator did not question them or take initiative at the right time or whatever. So that will come much later. So as I said, that first the initial responsibility will squarely be on the shoulders of the respective institutions' own governance structure, and that is where the things were. Now, by individual institution, different. You quoted 3 institutions. Each one had a different set of reasons why it got into trouble. In a Yes Bank, it is because it got exposed to 5 or 8 major groups. It exposure to those major groups. All of them got into NPA around the same time. It's by entire books. Otherwise, it is good, but this because of a high concentration of its exposure. So that was the one. And how the money went into that, there are several other governance issues which have come up in the media and information that is still under investigation. That will come out. It will bring out the final position. But the point is that whereas in ILFS, it is wide across. It created so many entities, and they indulge in certain accounting practices which got into which are not correct and correct. So that way in PMC, again, it was a clear fraud in the sense that you kept a completely pseudonymous and fraudulent accounts separately, and that. So that way individual cases could be different, but as I said, that primary responsibility will be on the shoulders of within the institutions only. Regulator or even a statutory auditor, their role is only towards periodically once in a quarter or once a year, they come and look at it. So at that time, to expect that they should have got the complete information or the position of the bank, that will be too much to ask for. You're on mute.
One last question, sir.
Yeah.
What is your opinion at 23.9 GDP contraction, sir?
This was to be expected because in that quarter, by almost every sector other than agriculture was completely locked down. When you had a lockdown, there is a question of giving any positive growth or the negative growth of this by extent. It is natural. So that was absolutely nothing to be worried about. Worried about in the sense that there is nothing unexpected. It was to be that way. But going forward, how the economy is going to grow, that is what is important. There, my take is that because of certain data which have come up in a very recent time, it gives a very, very positive position. Number one, the bank deposits have been increasing throughout this since March. There is a additional deposit growth of to the extent of something like 5 lakh crores of rupees. That means that 5 lakh crores of rupees have been surplus in the hands of the people and businesses. They kept deposits. They withdrew money, cash also around 2.5 lakh crores. There is another. Then credit had come down. There was 1.5 lakh crores of rupees of money has been paid back. So that means that in all, something like 10 lakh crores of additional income had been generated in recent times. That is a number. You look at the GST figures, despite the major segments of the economy had not been performing, had been in trouble. The GST collections in August and July had been something like 80 to 85% of the previous year. That means that the affected economy, it is only 15%. If that is true, then we are in good standing. So that way, there are data which are coming up, which is showing that in the coming months, our economy will be growing better.
Thank you so much. There are a lot more questions in the chat box. Due to the possibility of the time, we are unable to pose all the questions to you, sir. We'll definitely get back to you some other time. So now we come to the last session of last part of this session, that is vote of thanks session. As saying goes, feeling gratitude and not expressing it is like wrapping the gift and not presenting it. I thank profusely to Sri R. Gandhi sir for accepting our invitation in a very short time period to enlighten us with insightful disclosure on the topic. Thank you so much, sir.
Welcome.
Thank you, sir.
Thank you. Thank you.
I take this opportunity to express sincere gratitude to our beloved Principal Sir, Dr. J. Mallikarjunayya, for creating the platform to explore the things in a better manner during this COVID-19 period. Thank you so much, sir.
Thank you.
I also thank all the participants who ensured this event turned a great success. Thank you all participants. I will be failing on my duty if I am not expressing my heartfelt gratitude to the organizers who puts lots of efforts in organizing such events, great event. Thank you one and all for organizing a wonderful session. I request all the participants to fill the feedback form without fail. It is shared in the chat box. And tomorrow we have our last session scheduled at 3 p.m. and kindly join for the same from tomorrow at sharp 3 p.m. The link will be shared with all the participants all the participants. Thank you so much. Thank you one and all for presenting here.
Okay, good day. Thank you. Thank you very much.
Have a great day, sir.
Thank you. Bye.